You have successfully undergone your fundraising round. The investors are happy with the terms, you are happy with the terms, and now it's time to get to work fulfilling the obligations that you agreed to in your investment agreement or your investor agreement. But what if you don't actually meet those targets? Because in the startup ecosystem, founders are told to dream big, pitch large numbers, $1 million by year end, 100,000 downloads before the first quarter runs out, and all of these other big numbers. But did you know that if those big numbers and big targets make their way into your fundraising agreement, into your investor agreements, or even into any agreement that you signed with the investor, and you do not meet those obligations, do you know that you are legally liable for that? And what exactly is the extent of your legal liability, and what are the consequences of meeting or not meeting those targets? Hey guys, I'm Nneoma Grace, a corporate and tech lawyer passionate about helping founders and startups just like you to start, grow, and scale their startups to the zenith. And you cannot scale if you do not understand the importance of meeting the investor targets that you agreed to in your investment agreements. When an investor decides to invest in a startup, they rarely send the money into the startup's corporate account and wish them good luck and go on their merry way. 9 times out of 10, these monies come with terms and conditions, milestones that you actually have to fulfill. And also, for most investors, these funds are given in tranches or in bits, so that when you fulfill milestone A, you unlock funding B, and in several steps like that, so that they don't just transfer one large bulk amount into a founder or into the company's corporate account. And unlike banks or other traditional financial institutions that usually provide loans, aka you have to pay the interest, you have to pay the principal back with interest, most investors, especially in the startup ecosystem, we have like the venture capitals, the angel investors, and all of those categories of investors. Most of the times they invest in exchange for equity, that is ownership in your company, the ability to have a say-so in the management and in the running of your company. And when they give you the investment funds, it comes as in exchange for whether it's equity or whether it's a controlling position in or amongst your board of directors. Sometimes it comes with both of them, amongst many other terms and conditions. And in return, the VC not only gives you money, but it also gives you access to their network, it gives you mentorship, it gives you a whole bunch of other benefits that would come with the venture capitals or the venture capitalists, or the company or the investor that is investing in your company. Now, after you have signed the agreement, there are again terms and conditions that are attached or that come with those funds. And like I mentioned earlier, there are several ways an investor might decide to structure the deal. They might decide to release or to disburse money to your company in tranches, aka you receive a certain portion of the money upon signing of the agreement and another portion upon the fulfillment of a certain milestone. They might also decide to structure it as a lump sum deal where they transfer all of the money to you at once. It's possible. They might also decide to go through the route of convertible notes or simple agreements for future equity. That is usually if you have an angel investor or someone that invests in you pre-seed. Then there's also revenue-based financing, where instead of the investor being repaid a lump sum, they get repaid every single time you make revenue or every single time you make a sale for a particular product, as I'm sure you guys have seen on many episodes of Shark Tank. Then there's also equity financing, where again they give you these funds in exchange for equity or a stake of the ownership of your company. Then there's also debt financing, where it's basically a loan and you have to pay back interest plus the principal, or the principal plus interest. Now, these are the many ways that an investor may structure the fundraising or the financing deal with a startup. When they've structured these deals, again, they come with terms and conditions, and those terms and conditions might be all sorts of things depending on, number one, who the investor is, what they want, who the startup is, and what the startup wants. Or no two investment agreements are exactly alike. It's usually always custom made to fit the mutual needs of each party. And for these milestones, they can be financial milestones, they could be operational milestones, they could be user or traction or even product growth milestones. It could be anything. Now, after you have entered the agreement, what happens exactly when you miss an investor target? Let's say, for instance, you have entered into this agreement and the agreement says that you are meant to have 100,000 downloads by the end of the second quarter. Let's assume you entered this agreement at the beginning of the year and you're supposed to have 100,000 downloads of the application or of the the mobile application by the end of second quarter. Now, if you miss that target, say you do only 20,000 downloads instead of 100,000, or maybe you don't even get, maybe you do like 85,000, or maybe however much you do, but the point is that you do not reach that target. What exactly is the consequence of missing those investor targets? The first and most obvious one is clearly a breach of contract, because now you have promised, even in writing, promised to this investor that if he puts his money in your business, you are going to deliver on X, Y, Z. Now, when you're unable to deliver on those terms, this is a clear breach of contract that the investor, should he choose, can hold you liable for. Now, again, because it's a relationship, obviously the investor knows what is going on in the business. He knows, the struggles that you as a founder or your team is facing, and he knows all that. But that does not preclude you from fulfilling the terms of your obligation, the human aspect or the relational aspects aside. There is also the loss of investor confidence, because now this person that invested this amount of money in you on the basis or on the promise that this is what my product does, this is the traction it has gained so far, and with your fund, with the investor funds, this is what we're able to do. Now, when you're unable to fulfill your part or your terms or your obligations in that contract, the confidence that that investor had in you at the beginning, before investment was made, it significantly reduces. It might not go all the way, but it significantly reduces. Even if, again, you go through the human approach and the relational approach and try to explain, well, not necessarily explain, but communicate with the investor as to what you're going through as a founder, what the company is facing, the economic situation of the country, the political, and all of those other external factors. While there's that, while your integrity also can salvage the relationship, the point is that the confidence that that investor had in you at the very beginning has reduced to a level that may either be salvaged again by your relational skills or the relationship that you guys had built before then. And you'll find that once in your investors' confidence in your ability as a founder, as a company, as a team has reduced, you spend way more time now trying to convince them that, hey, I am the same founder you saw, you liked, and you invested in. You will spend more time defending your numbers. You will spend more time putting in the extra effort just to see that the relationship, that the confidence that that investor had in you at the beginning is somewhat salvaged. All in all, it's never really good on the side of the founder, especially when you don't meet those targets as a result of things that you could have controlled. Then there's also the risk of fraud and misrepresentation, because let's face it, there's a very, very thin line between dreaming big and giving someone misleading information. Let's take, for instance, your startup, your product has already been doing 50,000 downloads on average in a month, right? It's easy for you to promise to bump up that figure to 80,000 downloads on average in a month, rather than saying you want to make a jump from 50,000 downloads in a month to 1 million downloads in a month or in a year, or whatever the metric is. It's very, very it's a very different thing entirely. So you have to be careful as a founder to not make such misleading statements that the investor will wholly rely on, because when the investor wholly relies on the statements that you have made as a founder before that investment was made, when the investment has been made and you are unable to put your money where your mouth is, or you are unable to fulfill on your terms of the contract, you can be held liable for misrepresentation and fraud. and nobody wants that, especially because you're a founder, and I'm very sure that is not your first or your last funding round that you will go through. So it's all the better for you to not make such misleading statements, because your reputation as a founder, as a product, as a company is also at stake. The confidence that that investor had in you is also at stake. The network that that investor has and can open you up to is also at stake. So when you're pitching, when you're making your big plans and you're dreaming big and you're speaking large and trying to speak things into existence, be very careful not to make misleading statements that can be used against you. Another consequence of missing your investor targets is withholding future funds. Now imagine if the investment deal was structured as a tranche funding, aka when we entered the deal or when we signed the agreement, this first tranche will be released, but then you have to meet certain milestones before the next one is released. Now if you do not meet those milestones, the second tranche of that funding will not be released, and the longer it takes you to meet those milestones, the longer that money will be delayed, and by the time you eventually meet it, then some other thing might have happened, or a whole bunch of other things might have happened to further delay the release of that money. And so again, going back to not making unrealistic or misleading promises, when you're pitching yourself, when you're signing investment deals, make sure you set realistic goals that you can meet. At the very minimum, that you can meet with the help of yourself, your team, and the investment or the investors team that is coming in, that you can realistically meet, so that the next batch or the next milestone is easily fulfilled and you receive the next tranche of funding. Then there's also the activation of, say, maybe penalties or repayment clauses. Now think, for instance, now if this was structured as a debt financing, or there's some other kind of, let's say is revenue based now, right? And this investor has made this investment in your company, and you are unable to sell the total number of products that you said you were going to sell, or you're unable to reach that milestone that you said you were going to reach. He or she, the investor now, can invoke repayment clauses. If it's a debt, he can invoke repayment clauses, right? There can be other penalties that are, or maybe will be attached to that investor agreement or investment agreement, that if you do not meet the milestones you agreed to, those clauses can be invoked. And now, not only are you in trouble for not meeting your milestones, you are now being put under undue and unnecessary pressure to repay the amounts that you took and to account for the monies that you used. And then you still, on top of it, still have to meet those milestones, because I'm sure there are future amounts and there are other things that as a company you need to do. So altogether, that is not a very comfortable position for any founder, company, or team to find themselves in. Not only all of this, when you miss the investor or investment targets that you set for yourself, your team, and your startup, you risk the dilution of your own shares as a founder in that company. Now imagine if you've entered into this agreement with this founder on the condition that they take 20% equity, and let's say, for instance, there's also 20% that has gone out to ESOPs. There's also, you as a founder, you own maybe 35, your co-founder owns another 35, or however else you guys decide to share it. And in the terms of this agreement, the more milestones you miss, the more control the investor has in your company. That can significantly reduce not only your ownership stake, but your ability to have a say-so in what the company does. And this, I know, is one of the toughest pills for any founder to swallow, because you have spent time, you have spent money, you have spent energy on this product, on your startup, on your company. Now someone, because you did not meet your targets that you set, now someone else has the right to take ownership of your company or unduly reduce the stake that you have. Because the truth of the matter is, these investors, they need to make a return on their investment. And if you do not fulfill your part or your obligations, basically what would happen is like a death by 1,000 paper cuts, right? Because they won't just wake up and tell you, oh, you've lost all your shares in the company all at once that very day. No, the loss can come from a lower valuation, for instance. It can come from the you trying to get more money, thus, or giving away more of your shares to get more money, and Obviously, it will be your shares that will be diluted just to cover up for the missing or the cash that has not yet come in if it's a tranche, structured financing. And so many other tiny, minute ways. It can even come from the terms of the contract that you sign, because most times some founders who decide to not use lawyers, or who go about, they want to DIY the law, and they do not read or they don't properly understand the terms of the investment agreements that they sign, can unequivocally or unintentionally sign away bits and pieces of their equity or of their ownership stake in the company. And no founder wants that, and I, as a corporate and tech lawyer, do not want that for you. So try as much as possible to meet your investor targets. Now, should you say, oh, okay, you still don't want to meet your investor target and all these other previous consequences are not enough for you, some other consequences of not meeting those investor targets: you might have to renegotiate your contract on unfavorable terms, because now you're in breach of the contract. And so the investor already at this point has a little bit of more bargaining power over you, because now you have to kowtow to them because you missed your targets. And so they have like an upper hand really against you to say, okay, because you have missed your target 1, target 2, target 3, we have to renegotiate the terms of this engagement. Especially if, again, it's in a tranche or debt financing. If it's in a lump sum, then, obviously there are way more terms that would be protective of the investor. But if it's in a tranche financing, you're also at risk. If it's debt financing, you're at risk. So the contract might be renegotiated in favor of the investor, more to your detriment, and nobody wants that, especially if you've gone through all of this stress and all of the processes of getting yourself to this point. Another consequence is the difficulty of raising follow-up rounds. Let's imagine now you've successfully raised your pre-seed, you've successfully raised your seed, and you're, say, maybe in your series A, and you decide or you want to go all the way up to series B and C, and on it goes. And you miss investor targets in your series A, and you miss them to such an extent that it's like, okay, what exactly are you doing now? Like, investors start to question you. How easy do you think it will be for you to raise your series B and C, and on it goes? How easy do you think it will be for you to do just that? Quite difficult, right? So you see that meeting your investor targets or not meeting your investor targets, not only does it have direct repercussions, it also reverberates even down. It's like a chain link. Also, even in future, it affects not only the relationships you have now, not only the reputation you have now, but also what is to come. Because your investor doesn't come alone. He or she probably has, or they probably have, a network of other investors that are also looking at you, or that also have an eye in what you do. Now, if you bungle this one, obviously they may or may not spread the word to other investors that might look at you and be like, this founder is not serious, and nobody wants that. Another consequence is that you might be forced to exit your company, or merge with another company, or be acquired by another company. There might be a forced restructure on you, especially when you have missed targets to the point that it's like, okay, what are you now doing with the company? Or it's in the terms of the contract that you signed that if you miss these targets consistently enough, you might either be forced to exit the company, whether you're exiting as a founder yourself, or you might be forced to merge with another organization, or you might be forced to be acquired by another organization. And again, if you have spent time and energy and resources building your startup, that is one of the worst news you want to hear. Now, again, these are more extreme consequences where it has gotten to the point where the investors can't deal anymore, or it is basically what you agreed to. But on a typical basis, it rarely gets to this point, especially when it's something you can salvage through your relational skills or the relationship that you have built up with that investor or group of investors. Then there's also the psychological impact that this has on you, because for many investors, this is just one of the many investments that they have. But for you as a founder, that startup, that product, that solution, it's a part of your identity, right? It's time that you've put into it, is the sweat you've put into it, is the energy, is the resources that you've put into it, is all of these things combined to make that product your baby, in quote. Now, if you have consistently missed out on the targets that you set for yourself or for your team or for the company, and this is bringing some other consequences that you might not like, it has a negative psychological effect on you as a founder, because now you are stressed out because you need to figure out how to fulfill and meet all of these targets. Your team is stressed out because something is not working, or something is not working the way that it's supposed to work. Now your entire being is stressed. There's burnout, there's all sorts of things, and it takes a toll on you as a person, on the team, and it just takes such a negative toll on you. And so, as much as you're able, as a founder, as a company, as a team, try your possible best to, number one, do not set unrealistic goals for yourself and for your company. Don't make misleading statements all in the name of dreaming big and pitching big. Don't make such unrealistic statements. Make statements and make promises and sign and execute on promises that you can actually realistically fulfill. Let it be that the goal was too small and you have exceeded it. All the better for you. Rather than you set it way too high and now you can't reach it, and now you're having all these consequences. Because mentally, that is not a fun place to be in. Now, as a startup, other than making, realistic targets for yourself that you can meet, what are other ways or other things, other strategies that you can do to avoid missing investors' targets? The first one, obviously, make realistic promises and targets and milestones for yourself. The second one is maintain transparency with your investors. Let your investors know your struggles. Let them know your pain points. Let them know where things are getting a bit harder for you, because they are investors. They have a wide network to themselves or for themselves, and they have a wide range of experience, because you are not the first startup they've dealt with, and you will most definitely not be the last. So they have experience in this, and this is where mentorship comes in. This is where relationships come in. This is where communication comes in. Be transparent with your investors. The more they know about you as a founder, the more they grow, would I say, comfortable with you and confident in your skills. And the more they have context to why those goals were missed or why they were not reached, the more they have empathy towards you, because now, even if they might not be able to relate, they at least know behind the scenes what exactly is going on. Also, in your contracts, add legal and renegotiation strategies and clauses in your contract, so that should you miss a milestone or a target, other detrimental clauses will not kick in, or at least they won't kick in as hard for you as a startup, to such an extent that you are left worse off. Nobody wants that. Okay, so in the structuring or in the drafting of your investor and investment and so many other, the pack of agreements that will come with that investment, try and include in them remediation clauses or renegotiation clauses that will not leave you as a founder, as a team, or as a company worse off. Because at the end of the day, investment contracts or targets, they're not just words, right? These are binding, legal, and enforceable clauses and terms and obligations and responsibilities that you have to fulfill. So please, 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 in all of your dealings, especially as a founder, do not take such things lightly. And yeah, it's a quick one, guys. So that's about it for us today. If you found this video helpful, as usual, please hit that like button below so that this video will be shared to as many awesome people as yourselves. Until next time, guys. Bye.